The reason that we wanted to focus on this today is because there's a plumbing question that no one is asking. The conversation about gold is almost entirely a conversation about price and direction. That is the noise. The fundamental question is structural and it is rarely asked. What actually carries the metal, refines it, certifies it, stores it, clears it, prices it, and wraps it into something that an investor or an allocator can own? That machinery drew little scrutiny when gold behaved like a commodity. Now it is drawing scrutiny because gold is behaving like money. The argument of this note and video is simply that the bundle is coming apart into its constituent layers and that it is coming apart unevenly for reasons that are structural rather than political. Now, once the layers are named, the central mechanism is visible. A layer's mobility is inverse to what holds it in place. And that is why the stack does not migrate as a block, it delaminates. Hello everyone, welcome back to our channel and welcome back to another edition of Capital Insights. Now this particular episode is going to be dedicated to market structure, and today we're going to be talking about the gold stack, the layered infrastructure behind the reserve asset. Gold's monetary role is deepening faster than the market architecture that carries it. This note in this video sets the noise aside and maps the architecture itself as a stack of distinct functional layers rather than a single network. And we also argue that all the layers are now separating along the seam set by what binds each in place. The reason that we wanted to focus on this today is because there's a plumbing question that no one is asking. The conversation about gold is almost entirely a conversation about price and direction. That is the noise. The fundamental question is structural and it is rarely asked. What actually carries the metal, refines it, certifies it, stores it, clears it, prices it, and wraps it into something that an investor or an allocator can own? That machinery drew little scrutiny when gold behaved like a commodity. Now it is drawing scrutiny because gold is behaving like money. The marginal buyer out here is the official sector. Central banks added more than 5,000 tons to reserves in 2025 at a record transaction value of nearly $555 billion, a structural reallocation, not a tactical trade. And when an asset's monetary function deepens like this, reserve managers stop asking only how much and start asking where the metal is held, under which legal framework, how quickly can it be mobilized, and how concentrated that arrangement is. Those are the questions about the architecture, and the architecture was not designed to answer them at today's scale. And this brings us to one network and 6 jobs. For most of the modern era, the gold market ran as a single vertically integrated system, tightly coupled and concentrated in a small number of trusted venues. Metal was refined in a handful of facilities, certified to one dominant standard, stored in few recognized vaults, cleared through one settlement location, priced off one benchmark, and wrapped into instruments issued largely in the Western markets. The 6 functions existed as separate jobs, but they were all bundled. In practice, you could not take one without inheriting the others. That bundling was a feature. It pulled liquidity and trust in one place, which is exactly what made the market deep and cheap to transact. The argument of this note and video is simply that the bundle is coming apart into its constituent layers and that it is coming apart unevenly for reasons that are structural rather than political. And this brings us to the gold stack. Now, decomposed into functions, the architecture sorts onto a single gradient from physical metal at the base to the financial claim at the top. The useful observation is what changes as you climb that gradient, not the function, but the binding force that holds each layer in place. At the base, it is physical choke point. In the middle is jurisdiction. At the top, it is pure network effect. This snapshot gives you the layers, its function, what binds it, and where it concentrates, from refining to standard setting, to custody and vaulting, to settlement and clearing, to price discovery, and finally to the instrument or the wrapper. Now, once the layers are named, the central mechanism is visible. A layer's mobility is inverse to what holds it in place. And that is why the stack does not migrate as a block, it delaminates. Custody is the most mobile layer because a bar in one jurisdiction is functionally identical to a bar in another. Relocating it is a problem of logistics and law and not of market structure. Nothing about moving the metal degrades it. That is precisely why the vaulting layer is detaching itself first and the fastest. Refining sits at the opposite extreme It is bound by genuine physical choke point, concentrated capacity, and accreditation, and takes decades to reproduce. So it stays put even as everything above it moves. Price discovery is the stickiest layer of all because it's held by pure network effect. A benchmark forms where liquidity already is, and liquidity begets liquidity. The pool is self-reinforcing in a way that vault is not. Clearing sits between these two poles, jurisdiction replicable, but it still needs the participants to matter. Standard setting rests on trust and incumbency, slow to move, but telling. The incumbent is already flexing towards Asian trading hours. The net result is a stack that is coming apart from the bottom. The physical and the jurisdictional base layer separate first, while the network layer at the top holds the longest. Let's now focus on the seams under load. The clearest evidence that there are separable layers and not one indivisible network is that single administrative act pulled them apart in real time. At Mint 2025, the reclassification of 1 kilogram and 100-ounce bars under a tariffable customs code did exactly that. The instrument layer, futures price from those bar formats, dislocated from the price discovery layer of local spot, and the gap between them widened to roughly $100 an ounce. The refining layer responded on its own account, pausing certain cross-border shipments and recutting bars to specifications different for different destinations. The point here is strictly structural and the cause is beside it. The system that was truly a single monolith could not have fractured cleanly at one seam. This one did. A shock entered at the instrument layer and propagated unevenly across the others, leaving some layers dislocated and others untouched. Uneven propagation from a single shock is the signature of a stack. It's a tell that the bundle has already come apart into parts that can move independently. Next, let's read the map and specifically the 6 coordinates. Placed on the stack rather than ranked against each other, today's major centers read as coordinates, each showing where a function currently concentrates. Several overlap, none is exclusive. The map's message is only that the stack is no longer stacked in one place. Let's start with London, price discovery, and the local benchmark, the dominant purity standard, and deep sovereign custody. The layers held by network effect and incumbency. When we talk about Zurich, it's a refining choke point and a mature private wealth vaulting franchise, the physically bound base of the stack. New York is the futures and instrument layer and the largest official vault, the wrapper, and a sovereign custody anchor. Shanghai, a domestic demand price signal and parallel exchange standard, a second reference point in the settlement and standard layers. Hong Kong, a settlement and clearing node building out with offshore physical delivery capacity attached to it. And finally, Singapore, a neutral custody node adding clearing and new wrappers, vaulting plus instrument layers assembled deliberately. And let's wrap up this video with the Allocators read. Holding gold used to be a single decision. How much? It is now becoming several because the layers that were bundled can now be chosen separately. An allocation today quietly embeds 3 distinct choices: a custody decision, which jurisdiction holds the metal; a wrapper decision, physical bar, ETF, tokenized flame, or deliverable future; and a settlement decision, which network clears the title. Each carries its own risk profile. The old bundle market simply hid them inside a single line. For the allocators and specifically for the family offices, the practical edge is that menu at each layer is widening. Regulatory changes enlarging what can be held onshore and in what form. The removal of 5% cap on physical precious metals and the selected fund tax incentive schemes is one example. The arrival of tokenized gold for institutional and increasingly retail accounts is another. However, none of this requires a bet on which center wins. It requires recognizing that own gold has become a set of coordinates on a stack rather than a single allocation line, and that where and how you hold it are now the positions in its own right. That's all that we wanted to share with you in this video. This is an inaugural video on the gold stack, and we'll keep updating this particular series. Stay tuned then for our next episode.